Hello, this is Jeff Bish, president of MarketGauge.com, and in this video that I've put together for the Hot Scans blog, I just want to show you how a couple of things that we've been talking about over the last several weeks, even months, in Hot Scans education came together today in FedEx. Now, in my last post on the blog just a couple days ago, I told you to take a look at the first day of the trading year and pretty much box in that range, and that'll give you a good heads up of which direction you want to focus on that particular stock or index moving. So if you've done that and followed a bunch of stocks, I'm sure you have found some pretty interesting results. In FedEx in particular, we gapped up on that first day, as the whole market did, and we consolidated within that first day range. Now, there are still a couple stocks out there that have been consolidating, but many of them have moved in either direction, as you would expect. I'm focusing on FedEx today because it has a nice consolidation pattern. If you're in Hot Scans, then you have the education on the trading the consolidation packages now, or the consolidation boxes in your training section. And this is a great example of a breakout of that. But more than just the breakout, it's a breakout of that first day's range. And more than that, let's take a look at the 5-minute chart. And this is what really got me to do this video. Because a couple weeks ago, maybe a month ago, we did a special on institutional volume plays. And we look at that in terms of the 5-minute chart for the most part, and we look for these big volume spikes. So FedEx, keep in mind, has been consolidating within that first day of the year, so you're still waiting to see which way it's going to break. And just to be clear, the high of that range is 95.20. The day before the day we're looking at in the 5-minute chart, which is this big up day, we broke that towards the end of the day, and that high was 95.54 area, which lines up rather nicely with this 95.44 area. So if I take those values, look at them on the 5-minute chart, let's just round it off to a 95.50 level as being important. Actually, we can do this. You can see the high from the prior day, and you can see the 30-minute opening range. So what's going on here is we've got a breakout on multiple levels, and it's happening on this big institutional volume spike. So in the trading room yesterday, I've had FedEx on my watch list because of its location with that first day of the year. And so the big volume popped up on both my hot scans and in my chart, obviously, and we flagged it as a good looking breakout based on all these factors coming together. Big volume, it follows through on the big volume, it breaks the opening range, and it breaks prior day's high, which is a confirmation of the break of the January range, and it moves significantly higher. So a lot of things going on. If you understand the opening range concept that we teach as well, this should look familiar. The first day of January range should look familiar. And this hopefully will be an incentive now for you not to think that, oh, I missed this one, but there's other ones out there. And the next thing you want to do with the January range is look for these stocks that are hitting their year-to-date high. I mean, that's an easy way to scan for stocks that have been strong or their year-to-date low. And those are the stocks that are going to provide interesting opportunities on the long and the short side going forward. So just to kind of wrap up and review, let's take a look at a couple of interesting stocks, really high-profile name stocks that have played out this January concept pretty nicely. First of all, just yesterday, Bank of America took a big hit. All right, it was media was kind of harping on what's going on with Bank of America getting hit so hard when the rest of the financials, while some of them were weak, certainly weren't this week. All right, so Bank of America gets clocked, but hopefully, if you're looking at the January levels, it wasn't something you'd get hurt with. Now, you want to keep an eye on this one because this is one that would start to show up if you're focusing on stocks that are trading on their year-to-date lows, near their year-to-date lows. Another one that high-profile stock people would like to see going up, but here's Apple. All right, there's the first day of the year. If you like Apple, certainly it hasn't been the time to get involved quite yet. January kept you out of trouble with Apple. That's not to say it can't turn around. This is an interesting level of support right here, so I wouldn't be surprised to see it bounce, but at least I didn't get sucked in trying to get long Apple into, or I should say, out of the first day of the year. In fact, I sold it after being long when it broke that level. So I actually had a bias thinking that come the new year people would be excited about Apple and any tax selling would be out of the picture and it would rally. But this range let me take profits and stay out of trouble. And I can always look for another entry later. One other on the downside. SMH was looking really good starting the new year, but it never followed through, so you shouldn't have gotten hurt trying to like SMH on the long side, and now it's sold off. Like I said, it could easily come back, but until it gets back into the range and starts moving higher, you can wait on SMH. On the long side, stock that has been questionable, which way is it going to go? Facebook, once it took out that high of the range, it has been on a tear. Okay, another one. And now this one, remember, in the financial space, Bank of America didn't have such a great beginning of the year, waffled around, couldn't go anywhere. Goldman Sachs broke out and has held much stronger than the overall market. And they're still out there and they're still breaking. For example, we just saw FedEx. We have STX. STX just broke. Okay, so they're still breaking. And so here's one I'll leave you with that hasn't broken yet. Okay, so CI, you can see, still has not broken. The trend is up, so I prefer to play it on the long side, but I'll stay out of the way if it goes to the downside. All right, so I hope that's a nice review, and I encourage you to, if you've got hot scans, to now be scanning for stocks that are hitting their highs of the last 5 days, 10 days, 30 days, or lows of the last 5 days, 10 days, 30 days. And by doing that, you're going to find stocks that have broken and moved higher, or scan for stuff that is consolidating over the last 5 or 10 days, and you'll wind up finding stocks that are still nicely consolidated and waiting to make that first move of the year, which is, as I've said in the last post and in this video, a great one to follow. Hope that helps, whether you're a HotScans member or not. If you'd like to learn more about HotScans, you can find a link either at the bottom of this video or in the article that this video is hosted. Best wishes for your trading. I'll see you in the next video.